Okay, last time we were working on the Baldwin company example, and we said that we are heading toward cash flow from assets. And right now, the thing that we're working on is operating cash flow. We're going to have 3 sections, and we're also going to have a section for the net working capital and the net capital spending. As we go along, you're going to see that there will be things that are impact more than one of these things. For instance, depreciation both impacts OCF and NCS, and so we're going to be skipping around a little bit, but in the end, we will have those three things, and then we will put them together as CFFA. So back to our spreadsheet. We had just figured out our sales and our total cost. What else do I need to calculate before I can figure, or in order to figure out EBIT? So if you subtract interest and taxes from EBIT, what do you end up with? Net income, right? And we know that net income is calculated using depreciation. So we're going to have to find our depreciation. So let's get back to the story here as they're telling it to us. We're down at the bottom of page 233, I believe it is. And they're talking about net working capital. Oh, no, they also give us one more thing. They give us the tax rate. The tax rate, right? Okay, so I'm going to insert a couple of lines here. And the tax rate, 0.34. Okay. Now they tell us the net working capital is the difference between current assets and current liability. We already knew that. Baldwin finds it must maintain an investment working capital. It will purchase raw materials before production and sales. So let's talk about why you need additional working capital when you're starting a new project. In this case, we're going to have raw materials in our inventory, and we are also going to have WIP. What does WIP stand for?
Work in progress.
Yeah, work in progress or work in process. And that's a type of inventory. And then we're also going to have finished goods inventory. So we know that the inventory is going to go up as a result of taking on this project. Now, we are also going to have additional accounts receivable. Undoubtedly, we will be selling these balls on credit. And so our accounts receivable will go up. So that's also increasing net working capital. What about accounts payable? What do you think is going to do to accounts payable? Yeah, it's also going to go up. Oh, for shame, he's late. He's so weak, he can barely open the door. I feel sorry for him today. Okay, back to the story. Accounts payable is going to go up. Now you say, wait a minute, accounts payable going up is going to bring net working capital down. And here's what I'm going to tell you. As long as the terms are the same, 30 days, 60 days, on both the accounts receivable and the accounts payable, your accounts receivable should always be more than your accounts payable. Because if you are selling your finished product for less than you're paying for your raw material, that is a disastrous business model. You see, like, if I buy apples for 10 cents a piece, or for 25 cents a piece, and then I'm selling them for 10 cents a piece, that's a bad business model. And so accounts payable is going to go up, but it's not going to go up as much as accounts receivable. So we're not going to freak out about that. Okay, so we're going to go ahead and I'm going to start a new section here because now we're talking about net working capital. We said it's one of the 3 things that we're trying to figure out. So I'm just going to copy that and put it down here. And it's not going to let me do that. You guys know about Control C and Control V? I showed my mom Control F. She thought that was magic. Okay, and it is. So they tell us the net working capital. And we actually can put it up here in case it changes. Net working capital year 0 is how much? 10,000. Okay. So I can say equal to, and I just go up and reference that. And then they tell us the They tell us the net working capital. After that is a percentage of sales. What percent is it?
10%.
Yeah, 10%. Now I'm going to say it's years 1 through 4% sales. 0.10. Now, why did I say 1 through 4 and not 1 through 5?
Counting here.
We assume the net working capital goes to 0 at the end. Therefore, the net working capital in your last year is always going to be 0. And so I can even go ahead and put that in down here now to remind me not to mess that up. Okay, so for here, I'm going to say equal to, and it's the dollar sales multiplied by this percentage. What do I need to do right now to make that work when I pull it over? F4, I got to put in the dollar signs. And then I'm going to copy that over. Notice that it stays the same from time 0 to time 1. That's perfectly fine. It goes up. Notice that we've got peak sales in year 3, and then it starts going down and it drops off precipitously in year 5, going down to 0. Now, it's not really net working capital we're interested in. What is it? It's the change in net working capital. So I'm going to show you something freaky about Excel here. We're going to say insert symbols, and I'm going to find the delta. Where is it at? By the way, delta is a Greek letter, right? What the hell? Greek. So we actually have someone that speaks Greek in this class. Does that look familiar to you? These, yeah. Ah, crap. Let's try this again. So let's just think, oh, Greek and Coptic, maybe that'll work. Whoa, there we go. Okay, so I say insert, and everything looks fine. And then I type in NWC. Do you see what it does? I've been doing this since 2003. That bug has been in here for all that time, and they've never fixed it. And I've complained vociferously on YouTube. I'm surprised that Microsoft doesn't watch my YouTube videos and figure this out. Okay, so here we go. What can I do to fix that? I can just come back up here and say 11, and it drops it back to where it should be. So, what is the increase at time 0? It is just equal to the time 0 amount. Well, what's the increase after that? It's equal to the current period minus the previous period, right? And so, of course, it doesn't change any in year 1, but then we see that it goes up, up, and then it starts to go down, and then all the remaining money comes out at time 5. So we finally got one of our 3 things that we're looking for. So I'm going to go ahead and bold that. Okay, let's see what else they tell us here. Now they start talking about the bowling ball machine. So let's actually start talking, let's put together our net capital spending, start working on it. And we have a couple of things here that need to go into our net capital spending. First of all, we have the obvious one, the bowling ball machine. What else do you think should go into our net capital spending? Are we buying any of the machines? Are we buying anything else at all? But we have a cash flow we said we need to account for, because if we don't take on the project, we could sell the building. And so we need to account for that building. And so we're going to have also here the building. Now I'm going to do, actually I'm going to insert here, because we need to figure out depreciation on the bowling ball machine. Now, are we going to need to figure out depreciation on the building?
Yes.
No. Here's why. If the building has any depreciation left on it, it will continue on as is, right? So it's not incremental. It's not going to change as a result of taking on the project. And so we are not going to include any depreciation numbers for the opportunity cost of the building. The same is true when we do opportunity cost of the machines. We do not include depreciation for them. So, how much do we spend on the bowling ball machine? By the way, net capital spending, in this case, money out is positive, money back in is negative, just like your credit card statement. And so we've got bowling ball machine at time 0, we know is worth how much? 100,000. And then the market value at the end is how much? You know it's 30,000, but we're going to have to figure out this after-tax salvage value. That's going to give us that cash flow at the end. It's the full 100,000 going out, but the money coming back is not just the 30,000. We have to consider the tax impacts. And in order to consider the tax impacts, we have to consider the book value. And in order to consider the book value, we have to have the depreciation. So what do we need to do next? Got to figure out depreciation. And in fact, I'm going to stick even one more line in here. It's called MACRS. MACRS stands for Modified Accelerated Cost Recovery System. We've been told that this is a 5-year project for depreciation purposes. And if we look at table 8.3 on page 236, we can see that the way this thing is set up is with different recovery period classes. Now, the different classes have different stuff in them. And if we cannot find our stuff anywhere else, then we are to assume that it is a 7-year project, if I remember correctly. But for the most part, you'll be able to find them in your categories. And if you want to know what those categories are, look at page 239. The 7-year class includes office furniture, equipment, books, single-purpose agricultural structures. It's also a catch-all category because any asset designated not to be in another class or not designated elsewhere is dropped in as a 7-year. Now, I can tell you with certainty that that office furniture one is correct, because my new chair was bought for me by the university in 2017, and yesterday I found out that it's falling apart. So apparently my chair is now fully depreciated. By the way, does the actual life of the product have to equal? Absolutely not. If you look here, they've got computers in a 5-year class. That makes sense to you now. If I had told you about this 10 years ago, you would have laughed. You say, wait a minute, everybody replaces their computer every 2 years, right? Because they were just getting so much better. And notice that the single-purpose agricultural structure versus the multi-purpose agricultural structure would be in the 20-year class. Why? Because dairy farmers have a stronger lobby on Capitol Hill than the farming community at large. That's just dirty politics right there. Okay, now back to the story. We've been told that we're going to use this 5-year class. Now, I want you to notice something about these numbers. And we'll do the easy one. If you add all the numbers up for the 3 years, first of all, how many numbers are there? For the 3 years?
Oh, 4.
Yeah, there are 4. And how many years are there for the 5 years? 6. And so you don't count them, but how many do you think there are for the 20 years? 21, right? And so this has to do with the half-year convention. In fact, this thing is based on what's called a double declining balance with half-year convention. If you don't know what that is, ask Canada. He's our resident accountant, right? You know about double declining balance with oh, he does. Excellent. Okay. So, long story short, these decimals that we see here, when you add them all together, they equal 1. Every single one of those columns is going to equal 1. Now, what are we going to do with these decimals? We're going to multiply them by the historical cost to figure out our annual depreciation. And so what that means is we will have depreciated 100% of the asset by the time we get to the end of its depreciation life. So this is depreciation to 0. So if you're able to take this thing all the way to the end, this book value is going to be 0. In our situation, we have a 5-year project, but how many depreciation numbers do we have? 6. So are we going to be able to depreciate all the way to 0? No, we're going to still have some market value or some book value left when we get done here. Okay, so what I'm going to do is I'm going to go ahead and put these decimals in. By the way, any depreciation at time 0? Nope. 0.2, 0.32, 0.192, 0.1152, 0.1152, and then over here off to the side I've got 0.0576. And so I can figure out what will my depreciation be each year. And so what I'm going to do is I'm going to say it is equal to the Macker's decimal multiplied by this historical cost, which by the way is linked up above, right? So I'm going to click on this, but what do I need to do right now? F4, right? I got to fix that cell reference because otherwise it would follow along with us. And so there is our depreciation. And then we can go ahead and figure out our book value. The book value is equal to the previous book value minus the current period depreciation. So in this case, it's going to be equal to, actually, let's go over here. It's equal to this, and then I will say it's equal to the previous book value minus the current period depreciation. And I'll just drag that on over. And that is a whole lot better to me than trying to add, we could add another line in there for accumulated depreciation and use this formula right here, but why do that? It's more work and it's a greater chance for an error, so I don't do that. Now, notice that over here, we had 0.0576 kind of left over. 0.0576 times 100,000 is $5,760. It makes perfect sense. And so there's two ways to figure out remaining book value on things. You can go ahead and figure out how much it's already been depreciated, or you can figure out how much depreciation is left, right? And then multiply that by the initial cost, and that'll give you your remaining book value. So there's two ways to approach that. Okay, now I think we finally have enough information that we can go back up here and do our after-tax salvage value. So we are going to say that this is, first of all, equal to negative. Why does it have to be negative? Because the cash flow coming back is negative for net capital spending. The cash flow coming back is negative for net capital spending. And so then I'm going to open up the parentheses, and the first thing I'm going to put in is that market value, which is up here as $30,000 minus the tax rate times, open parentheses, the market value, which is that $30,000 again, minus the book value. Now, I'm going to put two parentheses here on the end. Why did I put two parentheses?
It closes the first parenthesis.
Yeah. So, rule of thumb, if you've got 3 of these, you got to have 3 of these, right? And then the reason we've got those outside parentheses to begin with is because of the negative sign. And so now we're seeing there that we'll have basically $21,758.40 coming back to us at the end of the project. Okay, now what about the building? So that takes care of the bowling ball machine. What about the building? We know we have our opportunity cost right there, $150,000. We know we have to include that, but what do we assume about opportunity costs? We assume that they all get recovered at the end. Do we assume that the value of the building went up or down? No, we just keep the same number. So here's what I'm going to do. I'm going to say equal to negative, and I'm going to reference this number right here. It's all still linked up. If I change it up above, both of those numbers will change. Okay, so now we can finally figure out our net capital spending, which is just equal to the bowling ball machine number plus the building. And I'm going to drag that across. And there we go. That's our entire net capital spending for the project. And that's one of the three things I'm looking for. So I'm going to make that bold. And then I'm going to save it. Any questions so far? Mr. Salas Hernandez, you doing okay? Okay, very good. He scratched his head. He may have just had an itch, but it made him look confused. It's kind of like being at an auction. You have to be careful, right? Okay, now back to the story. What's the only thing we've got left to figure out? We've already got to change net working capital. We've got to change in net capital spending. Or not the change, the net capital spending. The only thing that's left is the OCF. And so we're going to roll back up here. And now we actually have our depreciation, right? So I can actually just copy that depreciation. And I'm going to say equal to, I'm going to roll down here. And then I will copy that over. Bless you. By the way, are we going to have any operating cash flow in year 0? Absolutely not. Okay, so now I think, what could we do? What could we calculate next?
Taxes?
Yeah, so in order to figure out our taxes, we need to figure out our pre-tax income, right? Pre-tax income. And so I'm going to, and by the way, in this case, because we're not having any of the interest in our project, we know this is actually EBIT. So it's actually one of the things that we're looking for. So we're going to say it is equal to the sales, dollar sales, minus the total costs, minus the depreciation.
It's plus the depreciation.
Oh, sorry, you're right. Wait a minute, yeah. Wait a minute, no. That's when we get down here, we're going to add back depreciation. When we're actually calculating EBIT, remember we're subtracting out depreciation so we can get credit for it for taxes, then we have to add it back. Well, I'm sure glad I didn't listen to you. Okay, so we can copy this over. And we said there is no interest. What does that mean is my taxable income? It's got to be the EBIT, right? And so we can next figure out our taxes. And it's just going to be equal to EBIT multiplied by, and I'm going to roll up here, grab this tax rate, but what do I need to do right now? F4 to put in those fixed cell designators, and then I'm going to drag that over. Okay, now I can say, wait a minute, I've got EBIT, I've got taxes, I've got depreciation. I am now ready to calculate OCF. And so I'm going to do that right here. And it's going to be equal to EBIT minus taxes plus depreciation. We'll pull that on over. And so that's our operating cash flow. That's the third piece of the puzzle. Okay, now I believe we're ready to calculate CFFA, which means we're getting really close to being done with this thing. I'm going to go ahead and we're going to make it a new section here, C. And we will say this is CFFA, and it is equal to OCF minus the change in net working capital minus the net capital spending. I'm going to copy that one all the way across. So those are the cash flows that we are going to be discounting at a rate appropriate to the risk. And in fact, if you look at table 8.4, line 6, you can see that our numbers are very, very similar to theirs. The only difference is that we have not rounded our prices and costs to dollars and cents on a unit basis. That's the only difference. Okay, now let's talk about what we should do next. We are going to do NPV. In order to do NPV, we need a rate that's appropriate to the risk. Unfortunately, in this project, they do not give us the rate, and they also don't give us information to calculate a rate. Instead, what they do is they throw several different rates at us. So we're going to set our thing up to be able to accept different rates. So I'm going to set up a cell right here called rate, and we're going to start it out at 0.04, which is where they start out at. And then I'm going to calculate NPV based on that rate. There is a function in Excel that does NPV for you. That function is the NPV function, and it's erroneous. It's messed up. The good news is I can show you how we can fix it to get what we actually need. So we're going to say equal to NPV, and notice it pops up that thing and it tells you what you're going to have there. So I'm going to say open parentheses, and it highlights what do I need next. And so I actually need this rate. I'm going to click on that, and then I'm going to hit comma, and now it says value 1. Notice it does not say value 0. Here's what NPV function in Excel actually gives you. It gives you the present value at time 0 of cash flows starting at time 1. And so from our NPV perspective, do you remember that present value of cash flow subsequent to the initial investment? That's what the NPV function's actually giving you. And so I'm going to go up here, and the way I can select all of these cash flows, I could go in here one at a time and say this cell, comma, this cell, comma, this cell, comma, this cell, comma, this cell would do exactly the same thing, but I'm lazy, so here's what I do. I just go up there and select all of those, and then I close the parentheses. That gives me the present value at time 0 of cash flow starting at time 1. But it ignores the initial cash flow. By the way, what's the present value of the initial cash flow? It's the same as the initial cash flow, right? So all I have to do is say plus, and then click on this initial cash flow because it already has the minus sign on it, and I hit enter, and there we go. And so the NPV at that rate of return, the book says 123,641, ours says 123,643, so we're about $2 off, and it's all because of the rounding on the price and the cost, not a big deal. Would we accept or reject the project? Accept. Why?
It's positive.
Yeah, it's positive NPV. Okay, so let's see what happens when we do 10%. Now we've got 51,590 versus 51,588 for the book. Once again, we're $2 off. Accept or reject? Accept. And then for 0.15, we see we've got $5,473. In technical, the technically correct answer, do we accept or reject? We accept. Do I start to get a little nervous? Yeah, because I've got, if I run over by $5,500, then I'm a negative NPV project, and I'm out there putting in $260,000. If I run over by 10%, that's $26,000. I could easily swamp that 5,473. Okay, now the next thing they tell us is that at 15.67%, the NPV is equal to 0. What do we call the discount rate that makes NPV equal to 0? Think back to chapter 7.
The internal rate of return.
Yeah, the internal rate of return is a discount rate that makes NPV equal to 0. So if I put in 0.1567, in theory, it should come out to 0. But it doesn't for two reasons. Number one, remember we didn't round our prices and cost like they did. And number two, do you think it's really exactly 15.67%? It's not. And so let's see how we could figure out our IRR. In fact, I told you it's really easy to figure out IRR if we already have the stuff to do NPV. Well, here we go. We're going to say equal to IRR, open parentheses, and all I do is just select all of those cash flows, and there we go. Now, is it truly 16%? No. I'm going to do this, and you'll see that it's a bunch of numbers, right? How could I test to see if this is truly the rate that makes NPV equal to 0? I could come up here and I could say equal to, and then click on this rate, and it makes it really close to 0. Because remember, these are dollars and cents, right? So that's like way down there. Okay, so we've got our IRR. Then they tell us if it's 20%, ours comes out to be about $2 off, and it's negative $31,349. Accept or reject? Yeah, very definitely reject. Very definitely reject, unless it's like a safety-related or environmental-related project, where if we don't do it, the government's going to shut us down. Okay, so this is how we do these analyses. And I always do both NPV and IRR, just simply because it's so easy. If you've got NPV, IRR took us, what, 3 seconds? It's really easy. I told you one other thing that I would do while we had Excel up. I told you how we could find the second IRR when we've got the sign change. And so if we have our cash flows here, let's see, the first cash flow, do you guys remember from chapter 7? I'm sure you guys keep that just on the tip of your tongue, right? Chapter 7. Aha, here we go. The cash flows are negative 100, positive 230, and minus 132. And if I go ahead and ask this thing to figure out IRR, I'm just going to say equal to IRR, open parentheses. Got to put all this in here, close parentheses, and it's going to give me the same thing that the calculator gave me. It's only going to tell me the first one. So here's what I'm going to do. I'm actually going to put in a bunch of different rates here, and we'll start out with, say, 8.0, 8.1, 8.2, and then I'll grab that and drag it down until we get past 20. There we go. And I don't know why it's bolding it. Okay. And then for each of these, I'm going to figure out the NPV. So it's equal to NPV. Oh, by the way, I need to do this in percentages, right? 0.08, 0.081, 0.082. Grab those. Ah, come on. Drag it down. Okay, now I'm going to say equal NPV, open parentheses. I'm going to select the rate, and then I'm going to say comma, and then value 1 and value 2, or yeah, value 1 and value 2 would be these two right here. Now, I need to go ahead and hit F4. Because I want those to be fixed cell references. I always want to be referring back to those two cells. I'm going to close this, and then I'm going to just drag this down.
We don't have the initial investment.
Oh yeah, you're right, you're right. So I need to go back up here. Plus the initial investment, which I also, oh, not equal. Plus the initial investment. And I also need to hit F4 for that one. There we go. Now it's looking right. I drag this down. And here we go. How do we find these IRRs? It's where the sign changes from negative to positive or positive to negative. Because in order to be able to do either one of those, what do you have to cross?
So Y axis.
Yeah, you have to cross 0, right? And so anytime you do that, you can figure out, first of all, there's one there at 10%, and then you could scoot on down here and figure out that there's another one at 20%. So that's how you would do that. Any questions before we wrap this one up? Yeah.
Is there a quick way to graphically represent that?
You can create a chart in Excel if you were, wanting to do that. I'll save this, and you can go out and play with it if you like. I'll post it to Blackboard. Excellent. Okay, now there's one more thing I want to do. By the way, when I first build a spreadsheet, should I always trust that it's going to be right? No. Or the NPV function. So what should I do? I should always check my work with my calculator. Oh yeah. So let's get our calculator out here. What key am I going to hit in order to be able to put in this bunch of cash flow from assets? Yeah, CF, second quarter work. I've got negative 260,000. Negative, enter, arrow down. What's C01? Oh, it's not hard. Ms. Lee, what's C01? 39,800. You can see Ms. Lee was in a different county, so I'm going to try her again for arrow down, arrow down. What's C02, Ms. Lee? Say it out loud, please. Yeah. So I was in junior high band. I know you would have never guessed that. But my band director said, if you're going to make a mistake, make it loud. So just go ahead and shout that number out. None of us are going to throw eggs at you if it's wrong. What is C03? Yeah, 66, 845.76. Enter, arrow down. C04, 59, 895.7. Enter, arrow down, arrow down. C05, 224, 649.63. Enter. So you can go back up and check your work, make sure you got everything in. By the way, this one, do you think it's just dollars and cents, or do you think there's more to it than that? See, there's a bunch of extra stuff there. So we're gonna come out with just a little difference because we've got rounded numbers here. Okay, how do I figure out the NPV now? Yeah, we hit the NPV button, and so let's go ahead and do 4%. Enter, arrow down, compute. It's exactly the same answer we got when we put in 4% up here. Well, really close because we said about the little tiny rounding. Now, we've verified that our NPV calculation in Excel is working. We can also verify that our IRR function is working. If I just hit IRR compute, and it gives me really close to the same number. Really close to the same number. Should you check the rest of your spreadsheet with your calculator? Absolutely. You say, wait a minute, if I'm doing it with just my calculator, why wouldn't I just do it on paper? What's the answer for that? In case you have to do it again, right? Also, because if something changes, if you have to change one number, you need to go back and recalculate everything. That's a pain in the butt. You don't want to do that. Okay, but once you have it checked out, now it's good to go. You can trust it, and you can use it again and again on different projects. that have similar parameters, and you should be good to go. Questions?
You say this is going to be saved on Blackboard?
Yeah, I'll put it up right at the end of class. Now, I'm going to tell you before we move on that typically when you do your homework problems and your exam problems, they're going to be a whole lot more simple. Does that break your heart? No. Okay, so let's talk about a 5-year project. How I would set up a 5-year project for the typical homework or exam problem. Remember that we're figuring CFFA, and we've got to have our operating cash flow. We've got to have our change in net working capital, and we've got to have our net capital spending. And we know that things are going to be messy at time 0 because, first of all, we don't have any we don't have any operating cash flow. We do have net working capital, and we do have net capital spending. And so we're going to add all these, or we're going to do subtraction here to get CFFA. And you'll see why I'm only putting one dash in between here in a minute. So we've got year 5, which is the end of the project. By the way, what do I put here? This OCF tends to be the same in your homework and exam questions, right? It's just one OCF across the board. For the change in net working capital, we're going to have the plus change here and the minus change over here, because of course it's going to end up equaling 0. And then for net capital spending, we're going to have a cash outflow here. Let's call this the historical cost. And then we're going to have minus ATSV over here, because that's what you get back at the end, right? And this is also minus your returning opportunity costs. So why am I telling you all this? Oh, by the way, typically, in most projects, for your homework, there's not going to be any change in net working capital. There's not going to be any net capital spending in the intervening years. And so this is how we set up the problem. And so you're really only going to have 3 cash flows here to work with instead of 6. So this is going to be CF0. This is going to be C01. And what's F01 going to be? Yeah, because it happens 4 times in a row. And then this one will be C02, and F02 will equal what? 1. Yeah, it only happens 1 time. So this is typically how you're going to solve. A lot of students will make the mistake. They'll write out 0, 1, 2, 3, 4, 5. And they end up doing 4 times the work. Does that make sense? And then they end up typing in a bunch of stuff. You're increasing your opportunities for error. You're increasing the workload. Why would you do that, right? So this is the way that I would recommend that you do this. What if it's only a 3-year project? What would F01 be then? It's a 3-year project. It'd be 2, right? Because this will be years 1 and 2. What if it was a 17-year project? This would be 16, right? Save yourself a lot of time. Questions? By the way, when you run into one of these where you have to figure out these things and then put them into the chart, how much time do you think it takes to solve this kind of problem on an exam? Do you think it takes more time than the average problem or less time? More time. This is going to be one of the problems that you see, and you're going to read the whole description and look down at the bottom. And when it says calculate the NPV, you skip it. But you have to be careful to read, because sometimes all I say is calculate the change in net working capital, or calculate the after-tax salvage value. Those are really easy to do. And so you might not want to skip it. So you always when you see one of these problems, always go down and read the question and see what it's asking for. If it's simple, jump on it. If it's not, skip it. Questions?
Are there example videos on Blackboard?
Say again?
Example videos on Blackboard?
Yes, there are examples on Blackboard. In fact, I've got a whole video walking through this thing right here. And then, of course, we have our exam preparation questions, which will give you a really good idea of what the exam questions are going to look like. Does that help?
Yeah. The answers of them.
Oh, the answers to the... So, folks, how do you get the answers to the exam practice sets? Submit! If you would just submit, you would get to see the answers. And there's no risk in submitting, right? Because you can do it over and over again. You're welcome. Okay, other questions before we get back to our Chapter 8 slides? Okay, back to our Chapter 8 slides. Let's talk about inflation and capital budgeting. You guys are so fortunate. You have lived through a time when you actually know what inflation is, right? I used to give this talk and people were like, inflation, not a big deal. Is inflation a big deal now? Oh yeah. So, here's what's going on. There are two ways to look at any project, for the rate and for the cash flow. So you can look at it in nominal terms, or you can look at it in real terms. And if you think back to our discussion on bonds, when we talked about the Fisher effect, we said that the nominal rate is the one that includes an allowance for inflation, and the real rate represents your increase in your ability to consume. And when we're talking about nominal rates of return, those would be the ones that we observe in the market, like the required return on equity, required return on debt. Those are both nominal numbers. And those numbers, nominal cash flows, talk about the actual number of dollars we expect to receive, not the purchasing power of those dollars. If we look at the real rate of return, it's talking about the increase in our ability to consume, and the real cash flows are all explained or are all spelled out in time $0. And so the effect of inflation has been taken out of them. Here's what you need to know. We always discount real rates or real cash flows with real rates. We always take care of our nominal cash flows with nominal rates. And if we do that, we will get identically the same NPV. And here's why. Let's use little PV and little FV for real, and big FV and big PV for nominal. And we'll also use big R for nominal. So we can say that these are little times 1 plus R to the T. Is that right? Future value, oh no, it's not times, is it? It's divided by. Yeah, there we go, that feels better. Okay, now, something else to keep in mind though, is this little PV is going to be the same as nominal and real terms. The time zero cash flow is exactly the same, because there's no time for inflation to do its magic, right? Okay, now I can also show you that big PV is equal to FV divided by 1 plus big R to the T. And I could further break this down and say, well, this is really the real cash flows multiplied by 1 plus H to the T. What's H? Inflation. Inflation compounds just like interest. Inflation compounds just like interest. And then down here on the bottom, for the Fisher effect, I could substitute 1 plus little r to the T times 1 plus H to the T. Have I broken any mathematical laws? No. And so what happens to this 1 plus H to the T? Yeah, it cancels out. And so our number, this PV, is exactly the same either way. If I take real numbers and divide them, or discount them using the real rate, or if I take nominal numbers and discount them using the nominal rate, I get exactly the same present value for those future cash flows. And so I get exactly the same NPV. So that's what you need to know. Now let's talk about how we handle this in the real world. I used to assign this NPV project that you guys would have to create a spreadsheet, and I would give you all the numbers in nominal except for one in real. So let's say there were 23 numbers in nominal and one in real. Would I convert 23 numbers to real? No, what would I do? I convert the one real to nominal. And why would I do that? Two reasons. Number one, I'm lazy. Number two, how many opportunities are there for a mistake when you convert 23 numbers? 23. How many opportunities for mistakes when you only have to convert one? One. Does that make sense?
Well, you'd also run it with nominal number anyway, would you not?
Yeah, in fact, that's what I was getting around to my finale on this topic, is that when we do these projects in the real world, I've never used anything other than nominal. And it's kind of the default simply because the numbers that we get out in the market to come up with our discount rate are always nominal rates. Good point, thank you. Other questions? Now let's talk about investments of unequal lives. So you've got a machine that is worn out, and you are going to replace that machine with a new machine, and you're trying to compare these two options. And the two options have the same ability to create revenue, and so the only difference between them is the cost. And if they had lives of the same length, all we would have to do is calculate the net present value of all the expenses and select the one with the lower net present value of expenses. But most of the time, the machines will have different lives. And so now, not only are we dealing with a different pattern of cash flows, we're also dealing with a different number of cash flows. So one of these machines is going to last longer than the other one. And so what we're going to have to do is figure out a way to compare these on an apples-to-apples basis. And the way we're going to do that is through something called the effective annual cost or the equivalent annual cost. Now keep in mind that the sign on all of our cash flows when we're doing these calculations are going to be the same because they are all expenses. They're all expenses. What are we going to do? The first step, we're going to take all of those expenses and we're going to find the present value of all of them, and we're going to concentrate that at time 0. And then the second thing we're going to do is we're going to find an annuity that has the same present value and the same life. And the amount of the payment for that annuity will be the equivalent annual cost or the effective annual cost. And I'm going to do that for all of my different options, and then I am going to select the winner. Am I going to select the one with the highest equivalent annual cost or the lowest equivalent annual cost? Yeah, the lowest equivalent annual cost. So the best way to talk about this is to do an example. And our example is the tennis ball throwing machine. Tennis ball throwing machine. So, do you folks know what a country club is? Mr. Ingram, what's a country club?
Country club is a organization for typically wealthier people to come together and play golf, tennis, eat dinner, swim,
Drink.
drink.
Yeah.
But it's not hang out.
Exactly. Okay, so I'm going to take both of these things and put them together, and we'll say it's where wealthy people go to get away from poor people. How do you keep the poor people out?
Expensive.
You make it expensive, right? Does that make sense? Okay, so that's how we're going to keep the people out of the country club, and you would think, well, wait a minute, all of these rich people, certainly rich people all have friends. Not true. There are a lot of rich people who don't have friends, and so they don't actually have someone to play tennis with. Well, how are they going to practice their swing if they don't have anyone to play tennis with? The tennis ball throwing machine. So that's how we end up with analyzing this. We're a country club. We're trying to figure out about these two tennis ball throwing machines. Machine A costs us $500 to begin with, and then costs us $120 per year in maintenance for 3 years. Machine B costs us $600 to begin with, and then costs us $100 per year in maintenance for 4 years. Notice they've got different lives. The other thing I want you to make note of here is that the signs are all the same. You guys are used to seeing a negative sign at time 0 and then positives throughout. This is not like that because these are all costs. They're all cash outflows. Remember, the assumption is that the revenue is the same for either one. Okay. Now you say, wait a minute, if these are cash outflows, shouldn't I put negative on all of these cash flows? Feel free. Feel free. But here's what I'm going to tell you. I would screw that up. I would screw that up and I would forget and get my signs mixed. And so just because I'm lazy and I don't want to make errors, I just do them all as positive. So we said step 1 is we're going to take these cash flows and concentrate them at time 0 by finding the present value. We're going to use our CF keys to do that. And step 2 is to find an annuity that has the same present value and the same life as the project, and then look at the payment amount that we calculate. And that's going to be our equivalent annual cost. So get your calculators out. Here we go. CF, second, clear work. What is CF0 for project A? 500. And I've got to hit enter, arrow down. What is C01? 120. Enter, arrow down. What is F01? 3. It happens 3 times in a row. Enter. Now I'm going to hit NPV. That's how I'm going to get my present value of all these concentrated at time 0. And it's asking me for I. It turns out the required return for these machines is 10%. 10. Enter. Arrow down. Compute. So there is our first NPV, and here's what I'm going to do. I'm going to say store 1 in case everything goes terribly wrong. And then I'm going to hit the clear button a couple of times. Now I've got that number up there on my screen. That's still the present value of the expenses for project A. Here's what I'm going to do. I'm going to hit second and future value to clear out my time, value, money keys. What do you think I'm going to hit next, given the number that's on the screen? What button do I hit next? I'll give you a hint. It's going to be one of these. So I've got $798.42 here. The net present value,
It's pretty.
yeah, PV, right? PV. And then we know it's a 3-year project. So I'm going to put 3 in for N. What am I going to put in for I for Y? 10. I for Y. And then what am I going to compute?
Payment.
Yeah, compute the payment, and that payment is our effective annual cost for machine A is equal to $321.06. So now we need to do the same thing for B. So I'm going to hit CF, second, clear work. What do I put in for CF0 for machine B? 600. 600, enter, arrow down. What is C01? 100. Enter, arrow down. What is F01? 4. Enter. What button should I hit next? NPV. And what should I put in for I? 10. Enter, arrow down, compute. Is this the number you get? Okay, now, just in case everything goes terribly wrong, I'm going to say store 1, then I'm going to hit clear until I get that by itself. Then I'm going to hit second, clear TVM. What button should I hit next? Yeah, the present value. And what should I put in for N? 4, because this is a 4-year life project. And what should I put in for I for Y? 10. And what should I compute? Compute the payment. I'm getting $289.28. If you have to choose between paying $321.06 per year or $289.28 per year, which would you choose? Oh, come on. Think about this as your own money coming from your pocket. Yeah, we all prefer B, right? When in doubt, trust your greedy little heart, right? I want to pay less money. I want to receive more and pay less. Okay. Let's see what else I can tell you about this before we move on. Remember that the assumption is that the revenue is identical for both of these. The revenue is identical for both of these.
What are you saying for N on that one? 4 or 5?
Yeah, 4, because the life on it is 4 years. Remember, we're scrunching it all the way back to time 0, the costs, and then we're going to spread those costs out over the life of the project. So machine A had a life of 3 years, machine B had a life of 4 years. By the way, if they were equal lives, all we would have to do is find the net present value of the costs and choose the lower one. The reason we're going to have to do step 2 here is because they are investments of unequal lives. By the way, do these things actually happen in the real world? Absolutely. I will tell you a story from my own experience. In 1995, I bought a Honda Civic, and it was running great. And then my wife and I got promoted, and my wife, every time we moved, the deal was my wife could go back to school, right? And so my wife quits her job, she goes back to school, and then I was working on her Chevy Cavalier, and somehow I totally jacked it up, just destroyed the car. I know, I shouldn't have tried. Actually, the Chevy dealership jacked it up, and then I jacked it up, and then, well, anyway, we went back and forth destroying this car while I was spending money, right? Okay, so we decided we have to get a new car for her. And so I finally get the Cavalier running one last time to drive down to the Dodge dealership in Irving, Texas, where we traded for a Plymouth Neon. By the way, at the time, the Honda Civic, we looked at the Honda for her at that time, it was maybe $2,000 more. And so putting that in percentages, maybe 15% more. And at the time we were, our pockets were inside out, we just bought a house, and I was the only income in the house. And so we're like, we're gonna go with the cheaper car. Now, when I traded off my Honda, it had over 100,000 miles on it, and there was still nothing wrong with it. My wife's car, the Plymouth, only went 50,000 miles before it started leaking every fluid known to man. By the way, remember, I'm a mechanical engineer. You would think I would be able to look at these fluids and identify them. This thing was leaking fluids that I didn't even know existed, right? Like, what the hell? So, why do I tell you this story? Which one of these is the Plymouth Neon? The A. Which one is the Civic? The B. Now you say, well, wait a minute. What you've proven to us here is that you should always go with the more expensive option. Wrong. I could actually show you that as we increase the discount rate, one of these, or project A, will become preferred to project B. And here's why. Those present values of those future cash flows, if that discount rate's high enough, they get so small that only the initial cash flow matters. And so it's not enough just to say, oh, wait a minute, it's always just buy the good one. You don't know. You don't know until you look at it using the discount rate. Questions?
So what's your, okay.
Yeah, so given that we have to normalize it to EAC for these, would we have to normalize our evaluation of the NPV of projects with different lengths as well?
Okay, so remember that when we're doing a project analysis like we did with the Baldwin example, we are assuming that it's not a mutually exclusive project. And what's the rule? Accept all positive NPV projects. So we're not worried about the life on those. In reality, remember we talked about the hockey stick and how people can use the hockey stick to jack up your NPV? So that's when you might want to throw in, oh, by the way, what's the payback on this project too?
So what you're saying on the car example is that basically you might want to go with a higher monthly rate because the overall, let's say, i.e. future value of it would be higher or actually lower because of the discount rate.
So what you should do is first figure out the discount rate. And the easy thing to do on cars, what do you think the discount rate would be?
What's your APR?
Yeah. So we'll use the APR and we'll look at our expenses and we could come up with an equivalent annual cost. Is this as easy to do as it sounds for a car?
I think so. I mean, after you sit down and play with it for a little bit to figure it out, because I just did that not too long.
Yeah, I was going to say, sit down and play with it this weekend and let us know how it all works out.
I already did.
Yeah, okay.
I already did.
Yeah. Anyway, so typically though, the numbers are a lot simpler when you're looking at machines. So how do you end up with something like this? Well, the people who are selling the machine might actually give you these numbers in terms of we're going to do a 3-year support contract and it's going to cost you $120. And at the end, we expect the machine to be pretty much worthless. By the way, do you think a salesman will ever say that? No, but you know, it's a junky tennis ball throwing machine. And then you look at the other one and they offer a 4-year contract. So that's where you might get these numbers from when you're buying equipment. Okay, now let's talk a little bit about the general decision to replace. Stuff gets old. It gets old and it wears out. As stuff wears out, it requires more and more maintenance. And at some point, those maintenance expenses become enough to make it actually cheaper to buy a new one that's going to have lower maintenance expenses. I'll give you an example. My 2001 Nissan Sentra, when I first got her, she was just perfect, except for there were some warranty issues, but under warranty, how much did I have to pay to fix those? 0, right? So in the beginning, she's costing me only oil changes, gasoline, and wiper blades, that sort of stuff. But then as time goes on, maintenance starts to build. Do you think brakes last forever? No. So now I've got to do brakes, and then things start breaking down. And the last straw was when my starter failed. And I've got it, this is after we get to Springfield, I've got it in the garage and I'm looking at it. And the starter is like way down there. And then I'm like, I wonder if I can get to it from down below. And so I crawl under the car and I look up and the starter is way up there. In other words, the starter is at about the worst freaking place that you could have to try to replace it. And by the way, if the starter's not working, do you think I can drive it to the dealership? No. So I have to call Henry's to come tow my car to Youngblood Nissan to get them to change out my starter. And that was the beginning at the end of my relationship with the Nissan Sentra. That's when I started thinking about replacing it. Our bodies are the same way. I was sitting down, I'm 53 years old. I was sitting and the nurses asked me about my medications, and I'm listing them off, and I'm like, that list gets longer every year. She says, yes, you're wearing out. And she's right? And so the body's the same way. The older you get, the more maintenance. Most of you folks are like, I get up in the morning, I drag a comb across my hair, I maybe put on socks, right? Wait till you're 53. Ask Mr. Nyland, he can tell you. Okay. Now, let's see what else we've got here. So how are we going to decide? How are we going to decide when to replace the old machine? We are going to have two sets of numbers here. We're going to have the equivalent annual cost of the new machine. And then we are going to have a series of cash flows that allow us to figure out what the cost to hold on to the old machine for another year is. And as soon as that cost to hold on to for one more year exceeds the equivalent annual cost of the new machine, then I am going to go ahead and replace the old machine. And so the first thing we do next time, we will figure out the equivalent annual cost of the new machine, and then we will start looking at the old machine. Since I did not cover every possible calculation that will be on homework 10, I will go ahead and extend that one out to Wednesday of next week. If you don't see an announcement from me before 5 p.m. today, send me a reminder. It just means that I've forgotten. Any questions? Okay. If you've enjoyed today's show, please feel free to share, like, and subscribe.